Hey guys, welcome back to the channel. Man, I need a haircut. I've got to get one tomorrow. This is ridiculous. All right, guys, thanks so much for being here. Happy Friday the 13th, only Friday the 13th for another hour and a half here in the Central Time Zone. Tonight is time for Closed End Fund Friday night. So we're going to look at your favorite closed-end funds, and we're going to look at your favorite closed-end funds through the lens of the max factor, which is my own proprietary metric, which I like to use to evaluate these high-yield funds. All right. Let's look and see if anything's moving in the market. The only thing that's open right now is Bitcoin. Let's see. Let's see if it's moving. It's really the only thing to look at on the weekends. Well, we're hanging steady at 68.81, and we had a nice rally into the close. I mean, at about, or no, that was this morning. It had a beautiful rally this morning in Bitcoin. Beautiful Friday the 13th rally. Nice job, Bitcoin. All right, so let's talk max factor. So I have to go get my graphic. Let me go get my graphic real quick. Pretend like you guys didn't see that. There's William. Hey, William. All right, so here we have the daily factor. This is closed in fund Friday. Man, AI is doing a good job on these graphics. They just get better, and I really like the way that looks. And maybe the print may be kind of small. Let's do this. Let's see, you guys can still hear me, right? Yeah, you guys can still hear me. All right, so closed-end fund Friday night. Now, here's the deal with the closed-end fund Friday night. Some of these may not really be closed-end funds. I need to have a better way to pull the closed-end funds out of the list other than just picking them out by hand. But this is the list. It is what it is, let's just say. So usually I go by the highest yield first just to look at it. Usually the highest yield is the worst fund to look at, but whatever. Not all the time, though. So SWZ. So I should have closed some windows down. I did close leave. I did close some windows down, but not enough. All right. Gosh darn it. All right. All right, so let me get my graphic up here. Where did the darn graphic go to? Yeah, here we go. Okay, so the first one is SWZ. So SWZ is, I have no idea. I forget every week. SWZ, Total Return Securities Fund. This has the most generic fund. And if you want to look at a generic website, which is not what you guys are asking, check out this website. I don't even know who does this. How do you even do that? I mean, that looks like a template from, Microsoft Publisher in 1998 or something. Anyway, it may be a great fund. It pays a good yield. It pays about a 50% yield, and the NAV's been flat this year. So, all right, we'll get serious about this. I was just joking, though. All right, OCCI. Now, this is a good one. OFS Credit Corporation. Now, the NAV's been under pressure, but this thing is paying about a 34% yield. So, but the NAV's got dropped from 6 to 4 in the past year. So, be aware of that. And the next contestant is ECC. Now, ECC is, I have no idea. One of these I'm going to know. Eagle Point Credit Corporation. Okay. It looks kind of like the last one. It looks like the NAV's dropped from about 8 to about 4.5 over the past year. So, it's paying about a 37% yield. So that's Eagle Point Credit Company. The next contestant is CCIF. This is the Carlyle. Credit Income Fund. Okay. Do you believe that? Does anyone believe that? It's the Carlisle. Oh, you got it right. How did I get that right? I was just kind of making it up. I was going, well, I knew it's Carlisle. So let's see what Carlisle's website looks like. Well, they don't even have a website. All right. Anyway, let's go back. But the serious thing, this thing's dropped from about 7 to about 4 over the past year. Now it's paying a good yield. I mean, 32% yield, but it's dropped from 7 to 4. Okay, that's Carlisle Credit Fund. BPI, I forget this one. I always tell myself I'm going to remember this one. Is this BlackRock? Something that is you're supposed to remember. BPI, I should know. Blackstone or Grayscale Bitcoin Premium Income. Okay, Grayscale Bitcoin Premium. So this one, the NAV has gone from about 36 to 23.5 over the past year, but you've got a 28% yield off the darn thing. All right. That one is great. So that one, I'm going to know that one for sure next week. The Bitcoin Premium Income ETF. All right. So for sure next week. GGT is this is a good one too, but I always forget what it is. It's not Guggenheim. Is it Gabelli? Gosh, I get Gabelli and Guggenheim mixed up. Okay. So this is the Gabelli Multimedia Trust. Now this one, similar to kind of the other ones, is its NAV's under pressure. It looks like it's dropped from about 4.5 to about 4 over the past year. Paying a 25% yield though, not too bad. Not too bad. So that's the Gabelli Multimedia Trust, GGT. Then we have ECAT, and we have ECAT and BCAT. I put ECAT in here twice by mistake. I don't know how I did that or why I did that, but we'll just ignore the second one. Okay, ECAT. Let's check out some ECAT. Oh gosh, I just remembered I forgot to put the new ones that SB gave me, or not SB. I'm sorry, BR. That BR gave me. Okay, well they'll be in next week though. We have enough to do tonight. Okay. Oh, ECAT is the BlackRock ESG Capital Allocations Trust. All right, so this thing, the NAV has gone from 16 to 15.25. So it's dropped about 75 cents in NAV over the past year. Well, it's paying a 22% yield. No, not too bad. All right, so we have ECAT and then we have BCAT. So, gosh, why can't I ever remember any of these? It's a BlackRock Capital Allocation Trust. Yeah. All right, I got it right at the last second. All right, ECAT and BCAT, the ESG Trust and the BlackRock Capital Allocation Trust. So this one, the NAV is actually up a little bit. It looks like it got from about 14.5 to almost 15 and paid you about a 21% yield. This one's almost like free money because flat NAV, 21% yield. Not bad. All right. GOF. This is the Guggenheim or the Gabelli, or is it Gabelli or Guggenheim Opportunities Fund? Well, let's go look. The Guggenheim Strategic Opportunity. This is one of the better ones, if I remember. Well, maybe not. I guess it was prior till October. Man, they got hit in October. They must have had some kind of Bitcoin investment. Or, I mean, because that's about when Bitcoin really fell off the face of the earth. Of course, they're a closed-end fund, so they aren't very transparent. We really can't see what their top 10 holdings are. I guess we could go to portfolio. Let's see what this thing has in it. Okay, so it has bank loans. This fixed income. Bank loans is about a third of it. High yield corporate's about a quarter. Some other stuff. It has some equities, has about 70% of stocks, some more bonds, and just a little bit of everything. Mortgage loans, just your typical income fund, typical fixed income fund. Military housing bonds. So that's good. All right. Back to the show. That's GOF. So SRV. What's SRV? Does anyone know? I'll never remember this one, but this is a good Oklahoma. Cushing is a town in Oklahoma. But so this is called the NXG Cushing Midstream Energy Fund. And I believe Cushing is where the pipeline terminates at the Arkansas River, which is a tributary to the Mississippi, and you can get oil from northeastern Oklahoma, or gas and oil from, or I guess oil from northeastern Oklahoma down to the Gulf. And that's what Cushing is known for. So this is, and there's a lot of pipeline infrastructure up there. This thing's really taken off lately. Look, it just busted out to a new all-time. Is it all-time high or just or not an all-time high? Definitely not an all-time high. This thing got hit in the great financial crisis. All right, so SRV. Now let's go to the next contestant is CRF and CLM. These need no introduction. These are kind of the blue chippy funds of closed-end funds. CLM is Cornerstone Strategic Investment Fund. Anyway, this thing's gone from about $7.5 to $8, a little over $8 in a year, and it's paid 18% yield. That's hard to beat. That 18% is almost like free money because you didn't have to trade any NAV. You even got a little NAV upside, just 50 cents, but well, we'll take it. All right, then we have FS and CRF is the same thing. CRF and CLM are similar. Then we have FSCO, and I know that this one's a good one, but of course I forgot what it is. CO, FS Credit Opportunities Corporation. This thing has dropped from about 7.5 to about 5, a little bit under 6, 5.5, something like that, 5 3/4. But it's paid a 13% yield. Not too bad, but not great either. All right, then we have RIV. What is RIV? The River North Opportunities Fund. So this thing, boy, you want to talk about flat NAV? It looks like it was about 1180 a year ago, and it's at 1192 right now. That's nice. Paid 12.8%. All right, River North Opportunities Fund. And then after that, our next contestant is FAX, F-A-X. The Aberdeen Asia Pacific Income Fund. And this is, I mean, the NAV's gone up about 15 cents in the past year. You know, from here to here. Now, it went down, it's gone up, but it's flat over the course of a year, paying about 12.25%. All right, so that's FAX. Then we have YYY, which is actually not a closed-end fund, but it's an ETF made up of closed-end funds. So I'm going to throw it in here. And we can even see which closed-end funds are in this ETF. And they have this Aberdeen fund, a different Aberdeen fund than the one I showed you guys. They have the Aberdeen Total Dynamic Dividend Fund. And they have some ECAT, some of that BlackRock ESG Capital Trust, and some other stuff. Anyway, that's a fund of funds, paid about 12%, and the NAV's up about 40 cents over the past year. So that's not bad, right? And then we have ASGI. This one's really good. What is this? Aberdeen Strategic Growth or something? Or Global, okay, Aberdeen Global Infrastructure Income Fund. Now, this thing's a monster. This is an absolute monster. Gone from 19 to nearly 26. Well, it'll be 26 soon. Looks like it almost hit 26 the other day. Gosh darn it. Great job. Okay. That's obviously a good one, probably going to be the winner. Well, it doesn't look like it is. Anyway, it doesn't look like it is. Then we have Sirloin. Now, Sirloin is SRLN. It's a senior loan closed-end fund. So it's a closed-end fund made up of a bunch of bank loans. All right, I'm getting some good background information from BR. I need to read those. Anyway, okay. Sirloin is almost flat on the year. I mean, these senior loans, almost flat, and it's paying about 7.72%. probably pays about the prime rate. I would imagine a senior loans, or corporate loans that are at around prime, or or which might be prime plus one or whatever, 6-7%, something like that. And this is taking the other side of that. Anyway, all right. Well, that's ASGI Sirloin, and then we have UTG. The Reeves Utility Income Fund. Wow, this is something else. I mean, only pays 5.8%, but heck, the NAV's gone from $32 to $40. So it's made money almost like a stock in the sense that its NAV's up 20%. Or was that right? Something like that. Yeah, it's like 25%. The NAV's up like 25%, and so any little dividend you're getting is just gravy this year. All right, so that's that. So Brad is saying SRV is owned by NXG out of Dallas, and that's the Cushing midstream one, I believe. GOF. Okay, and GOF has a special drip like Cornerstone. So Cornerstone has a feature for the people that don't know where you can, they call them rights offerings, and you can, I guess, exercise your rights offering and you can pick up shares. It drips at a lower price. It drips at the net asset value, which is like a good deal. So GOF also has the special drip like Cornerstone. So Brad, is there any other, is it just Cornerstone that does that rights offering with the special drip and GOF, which of course is the Guggenheim Opportunities Fund, or is there any other ones that do that? I was just curious. Yeah, the Guggenheim Strategic Opportunities Fund. Yeah, I was just trying to show you that my memory at least lasts 5 minutes. Well, this thing's been under NAV pressure, but all right. The opportunities must not be that strategic lately. All right, hey, Bond's in the house. Okay, Brad says the First Trust website looks like one that you just pulled up. Yeah, it does. I really say that one is even more plain Jane than the First Trust one. The First Trust one, it looks like it was built, for Lycos with the or something, built back in the day of Lycos and remember Alta Vista, and I mean those were the cool days. The late '90s, early internet days were awesome. But I mean, yeah, and then of course William's in the house. We've already said hey to him. All right, so yeah, but that's some good information. Brad is our expert. Marcus is kind of our expert at some certain things, just generally finding exotic funds, and also with the auto callables. But BR has a real handle. Brad, in other words, has a real handle on these closed-end funds. All right, so let's see what else is going on. Let's look at some other metrics and see if any of these are any good. Let's see which ones are the most volatile. Or well, let's just look at the stable DEX, which is just the inverse of the volatility. So the highest stable one is this SWZ, which is the one with the website from 2002. And why don't they just put some effort into the name, the Total Return Securities Fund? Are you serious? I mean, I guess. I mean, you have to have it a cool name like the lion, or you has to have a mascot or something kind of, you have to brand a little better than this. I mean, it's like they took no effort into the branding whatsoever. I mean, this thing just amazes me. All right, but anyway, be that as it may, as far as volatility goes, it's traded between a range of 670 to 590 over the course of a year. So it'll be like a stock trading between 67 and 59. It's extremely steady. It hasn't gone anywhere. So that's why it is. In fact, it's 4 times as steady as the SPY. And that's what the stable DEX tells you, how many more times stable it is than the SPY. Then we have 3 Point Sirloin, the senior loan portfolio, 3 times as stable as the SPY. ASGI, the one that's gone straight up, is 2.5 times as stable as the SPY. I mean, now you only make 9.5% on Sirloin, you only get 7, but man, those are some safe ones. Those would be towards the barbell of the safety end. Jackson, hang on, let me let him out of here. We had a friend come over. He wants to go say hi. All right. So, and then we have YYY, which is also pretty stable mathematically. In fact, anything that's above a 1. So, you know, the top 2/3 of these are more stable than the SPY. And that's what closed-end funds are known for. That's good. So let's look at the riskiest one, or the least stable, let's just say. So it's going to be UTG. So let's just pull that up and see what that looks like graphically. Well, I mean, at least it's unstable going the right direction. But I mean, you know, over the course of a year, it's traded between 28 and 42. So that's, hang on. So yeah, that's on the wilder side, but that's not even really too bad. But anyway, but that's, you know, that's towards the riskier end. All right, let's see what Brad is saying. He's saying UTG also is doing well at increasing the dividends. They can all do the rights offering. Okay. Cornerstone and GOF are the few that do. Okay, so they all have a rights offering. I guess that just comes with closed-end funds. I'm getting the things confused. I guess the DRIP and NAV is like a special rights offering, or so it's anyway. Okay, so I'm conflating the two of them. But the DRIP and NAV is, and I know a lot of people like Cornerstone. The other thing about Cornerstone that's impressive is it's a 4-star fund, and it's been around for a long time. I mean, let's see how much history this thing has. And it goes back to 2008 at least. Now that's some NAV decay though. The NAV's gone from, you know, $90 to $8. But I mean, it took you 25 years to get there, and I bet it paid dividends the whole way there. So whatever they're doing, it's 4-star ranked on Morningstar. So it's, you know, that one has a lot of track record behind it. So Brad is saying a lot of closed-end funds will do a discounted, which is different than the DRIP at NAV. The DRIP at NAV is a big, and I guess that's the one kind of a disadvantage to closed-end funds is oftentimes they trade at a premium to NAV, because closed-end funds, I believe, unlike ETFs do not trade on supply and demand. They'll just, if everyone wants to buy, they'll just print more shares for you. And when people sell it, they destroy the shares. It's totally different technology than closed-end fund. But so closed-end funds will trade lots of times at a premium to NAV, and I think that's because they are unable to print new shares. So they do have, you know, supply and demand characteristics. So this is not a closed-end fund channel. I mean, anyone that wants to get into that, I mean, what's that one book? There's that one guy that does a great job that a lot of people like, the Income Factory guy. And he's the man to go to, and he has all kinds of social media. I forget his exact name, but people like him. All right, so Brad is saying Fidelity shows a DRIP and NAV for GOF. Okay. Marcus is the ETF hunter. Okay, yeah, that's true. And yeah, Brad's saying, okay, so that it only goes back to 2008, I guess, you know. Anyway, Brad's saying that CLM-CRF launched in 1988. So, well, let's look at that. Let's see if we can, let's go back CLM to SPY and see how far back it goes. SPY came out in, well, heck, SPY didn't even come out until 1993 or something. So I need to do an older fund than that to see how far back it goes. All right, let's just do maybe a stock, like a stock that's been around forever. I don't know if this will show stocks. Yeah, I punched in Eli Lilly, but now Eli Lilly's done so well, it's messed up the proportion. So that was a bad thing to do. Let's put in Coca-Cola. I don't think that one's done as well. It's not a big of a growth play as Eli Lilly. Coke is still a growth play though. Look at how much Coke has outperformed CLM. But Coke pays you no dividend. CLM is an income fund. So what did I always say? And this works on any of them. An income, a high distribution, is a tax on the NAV's upside. So it makes sense that CLM hasn't done nearly as well over time as your average growth stock. I could put in Walmart and it would be beating it too, or whatever. And Walmart's done really well, but well, you guys get my point. But yeah, that is a. Oh yeah, watch this. I wasn't going back far enough. Oh, this thing only goes back to 95. Okay, so that's as far back as we can go. Well, whatever. It's still impressive. All right, back to the metrics. So so we looked at StableDex. We'll look at the Quandex. This is basically the long-term max factor. It's the same inputs as the max factor. It looks at a back at a year instead of just at a. This is more of an allocating index, and the max factor is a trader's index. Anyway, but of course ASGI has got to be number one on here. I mean, you have an instrument that pays 9.5% yield, but its NAV is up 24%. That's incredible. I mean, that just in its 1 year total return is 53%. That just, and yeah, and you get the 9.5% of this, rate is just gravy. Anyway, then Sirloin is a good one on. If you look back on a long term basis, I mean, Sirloin over the past year, the price was 41. Now it's 40. It's dropped a little bit, but that's been a good one. YYY has been a good one, paying at 12%. Steady NAV paying a good one. Anyway, okay, so that's the Quandex. Those are the longer term max factor. The short term max factor is the max factor. And yeah, number one is ASGI. Number two tonight is UTG. Number three is FAX. Number four is YYY. So we have Aberdeen, UTG, FAX. I've already forgot what UTG and FAX are. I remember what BCAT is, but anyway, I just don't like these. These ones are great that are highly rated, but it's a 5.8% is not a lot of yield, but it's not bad either when you combine it with a 10% NAV return. So any of these funds might work for you. The worst ones are BPI, ECC, and CCEF, but those ones those were the ones that the NAV was going down and to the right. We don't like that look, right? Yes, Stephen Bavaria is the guy with the income factory guy. I like his social media, and yeah, that's all I know about closed-end funds is ask Brad or go read Income Factory. Yeah, good call. Okay, good call, Brad. Let me show you this really quick. Let's look at CLM, Cornerstone Strategic Opportunities Trust, and then we're going to hit compare to a little CRF. What? CRF, yeah, Cornerstone Total Return. Okay, so over the past month, I mean, who cares? Let's go max. Yeah, here we go, back to 1988. Yeah, those are good. Well, we got to put SPY in here. Now, there's no way, surely SPY is going to beat it because SPY is a growth stock. SPY doesn't pay much of a dividend. Yeah, and that's we'd expect it to. But it's amazing that these things could be up 1,000%, and you've got a dividend also. So, but of course, there's no free money. If you didn't need the income, you would just invest in growth, and you make the 2,700%. But if you needed the income, maybe something like this might help, right? Yeah, that's a good tip. Let's see how much more the Qs are up than the SPY. Well, look, and the Qs didn't come out. So the Qs came out at 99, right in time for the tech crash. Well, they actually went up quite a bit before the tech crash. It looks like, boy, those poor people that bought the Qs on the day it came out. It came out at 46, and it went to, before it crashed, it went to 94. Those people probably thought it was free money, doubled their money in the Qs. It's the greatest index ever. And then it goes down. But don't listen to people that tell you that the market always goes up. This is the NASDAQ. The NASDAQ didn't make their money back for 15 years. So the market doesn't have to always go up. The SPY could go into a 5 or 10 year, 15-year drought. It can happen. These people that tell you the market always goes up, it generally goes up, but it doesn't always go up. And that's prime example. That's not just because it's the NASDAQ. That can happen in individual stocks also. My family, like I always, has a little stock in Eli Lilly. It was dead money for like 15 years. I meant to compare, but anyway, it was the same thing. It did not. Here, let's just show it here. Let's look at. We'll put Lilly and we'll compare Lilly to CLM. So we're staying kind of on the same topic. All right. Yeah, there's CLM down there making 900%. Eli Lilly's made 24,000%. So in 2000, Lilly was 36.66, and then we sold most of ours at a low in 2004, 2005. When my grandfather passed away, we were able to sell it and diversify it. Now, how smart were we? We should have just kept all of it. But whatever. We sold all of it and diversified. But yeah, so basically Lilly was dead money and we didn't do it because we hated the stock. We loved the stock. My dad's like me. There's no reason to have a lot of money in any one stock anyway. But yeah, Lilly went from 50 and it took, this is one of the greatest stocks out there. They say, it's health. People always need healthcare. Yeah. Still doesn't mean that the business is good. And it took until 2014 to get back to its 2000 price. But then if of course, if you held on, you're up 24,000%. So I wonder how much money my grandfather would have had if he would have never spent any and still been living. I wonder how much that 24,000% turned in a lot of money. Anyway, yeah, that's good. That's a good tip on stock analysis. That's a good place to look at it. UTG's very solid. UTG's a great core fund. Brad loves it. And then he surrounds with high yielders. So it's the barbell principle, right? Or the barbell strategy. CLM launched at 51 cents in 1988. Wow. That's incredible. Let's put the SPY on here too. Let's put the SPY on here too. But look, so the SPY on the other hand, now let's look at the SPY. The SPY made a top and looks like 2000, of course. Yeah. SPY made a top in 2000. It was at 90 or something. Okay, look how long people say the market always goes up. Okay, all you have to do is a SPY. Well, no, there you lost half your money. By 2002, you lost half your money. It went from 90 or a third of it. Then it started to go back up. You're still down a third of your money. It's now the SPY is at 78, 88, 90. Okay, you finally got your money back in 2006. You broke even 5 years later. The markets don't always go up. The market can and will do this, and that's what they always call a lost decade. Think if you worked hard all your life, saved up your money to retire, and you retired in 2000. But but you're also kind of hoping for a little bit of appreciation as in early retirement. You still need your income. You still need your portfolio to grow, unless you're just filthy rich. But most people aren't filthy rich. So, you could have retired in 1999 with the SPY, and your portfolio would have lost a third of its value your first 2 years into retirement. So you retire with $2 million. You think you're all right. Well, no, now you have $1.4 million. You're still probably all right, but is it going to keep going? And then it takes you 5 years until your portfolio finally starts growing. But if you held on, you're doing all right. You're doing all right, because then the SPY went really low again in 2008, and it went down and it hit a low of like, well, it looks like it hit 49 or something. And then recently it's been trading at 691. So from 50, call it 50 to 700, basically. I mean, that's incredible. That's incredible. Let me make that go away. Sorry, you guys. I mean, but anyway, I was just showing you where I was just measuring that you can't really tell from this chart, but the early 2000s was a terrible time. And if you were right on the edge of being able to retire, and you did retire, you may have had to go back to work really in 2002 or something when you lost a third of your retirement. Say you retired with 600,000 or something, and then you're down to 400,000 and you're 66 or something, you know. Welcome to Walmart. Yeah, okay, correct. Bond's saying that these comparisons, correct, don't take into account the drip at NAV. So CLM has even done better than this is showing, and it looks really good on here. It just, I mean, you know, when I compare it to something like Coke or Lilly, it's, you know, but yeah, it looks really good on here. But this, it does even better than this. Skeptic says, how does everyone feel about future ETFs? You think they're underrated? So are you talking like hard and you're talking COMD? Are those the kind of futures ETFs you're talking about? What about CTA? CTA is a good one, or it's another idea for futures. I really don't know about those that much and don't really cover them that much. I mean, but the idea with futures or with commodities are they're inflation hedges. So they're definitely good lately. There's times though, Marcus, where you could have bought those. Let me show you. There's times when you could have bought those things and thought you were hedged, and they lose half their value. Because and it's usually whenever the market's going good, going well. Let's go like on. Okay, so hard is it's green. Okay, so where is it? Okay, so yeah, like that thing was at 30 in March of 2025, and it took till October. Okay, so it went straight sideways for 6 months. But anyway, what I'm saying, if you enter a deflationary economy, like I'm thinking 2018, 2019, those commodity things get killed whenever interest rates are down, inflation's down, and the market's going up. But that's what they're for. But they're for the bad times. They're for inflation. They're for inflation. Of course, you could also just get something like GLD, and that helps you typically in inflation. But yeah, the commodity ones are cool because they pick a basket of gold, silver, wheat, oil, whatever. Yeah, I like the idea of them for sure. All right, Brad say, Max, can you do a comparison between hang on a sec. I'm gonna let Jackson out. He wants to come say hi. All right. Max, do a comparison of ASGI, the champ, yeah, versus JOF. Okay. All right. Well, let's do it here first. ASGI, JOF. Okay, so let me put in, is JOF. Okay, so, and do it for 1 year. Okay, let's go back about a year and a half, something like that. Heck yeah, those are both good looking right there. That'd be JOF, yeah. Now, you can see that JOF doesn't pay much of a yield. Well, it looks like it pays a little yield. Okay, so let's do some more looking into JOF. Let's go right here. The Japan Smaller Capitalization Fund. Well, small cap Japanese stocks, year-to-date performance up 10.92%. For the past year, it's up 55. 3 years, it's 80%. Yeah. Yeah, it just pays a 5.79% yield, but it's free money lately. Even though there's no such thing as free money, it's been acting like free money. All right. Brad said he posted an option video on Discord. Okay, I will. Absolutely. Okay, HFGM. What the heck is this? Let's compare it to HFGM. Let's compare it to ASGI. Ooh. All right, HFGM. Let's take a look at HFGM. All right, so that's a monthly chart. Let's get it back here on daily. So, okay, there we have it. Wow. I mean, went from 25 to 33. I mean, 5.25% yield. They have some S&P futures. They use some leverage. And they have some high yield corporates. I think HY is HY futures. What are HY futures? Anyway, I don't know what HY futures are. And they have some Nikkei futures, some gold future. Is that maybe copper, or copper's HG, right? HY futures. Anyway, they have the Nikkei, which is a stock index. They have gold, and they have some 5-year notes and some 30-year bonds, the U.S. long bond. Then they have Vanguard Emerging Markets. That's a hot one lately. Good job. They have some Australian, they have the Aussie US dollar cross. And yeah, a little Forex, a little everything. Look at the money coming into this fund. It just had 3.8 million under management right there. And now they have about 108 million. Wow. Yeah. That is a good looking fund. Yeah. So I've heard of this. Obviously, I've heard this one before. It's called the Unlimited Global Macro ETF. So this is a hedge fund in a box. There's different types of hedge funds, but this is a global macro hedge fund where they try to identify the macro stories over the next year and it's a growth fund. They're investing for growth here and trying to look ahead. And so that's why they have, that's why I'm sure they put in this Vanguard. People have been talking for the past 6 months, emerging markets for the past year. So they have some emerging markets, and then they have some gold and, yeah, that's a good one. That is a good one. Let's see. JOF is a monster. It's a very quiet fund. Yeah. I already forgot what it was. Oh, yeah, Japan smaller cap. Yeah, that's right. All right. Yeah, that looks better than CTA. Exactly. So CTA is the name of the fund, but it's also the name of a strategy. You hear people talking all the time. I need to get some CTA. I have a it's even a job. I think a person can be a CTA, a commodity trading advisor, and it's a strategy, but it generally means those guys that allocate to commodities in such a way to try to prevent inflation. I mean, that's my idea of a CTA. Some CTAs are long short. They might be long the Nikkei and long the bond, and then short gold, or long gold and short the bond. Yeah, it's a hedge fund type stuff. So Mark is saying HFGM pays annually. Oh, that's the drawback with it. CTAs quarterly. We had one of our friends in Discord had some CTA for because he was worried about inflation. And I think he got rid of it. I don't think he liked it anymore or something. But I mean, over the past, okay, let's look at it over the past. What is this? 5 years. I mean, it's gone from 25 to 29. It has been kind of trending up lately, like inflation has been trending up. But yeah. Brad is saying First Trust is launching 7 barrier funds in February. Marcus will be busy. Yes, absolutely. Side note, Marcus is saying CTA is in the fund-to-fund. SVOL is essentially a fund-to-fund anymore, it seems like. SVOL owns CTA in it. Yeah, what is it in SVOL? Let's look at SVOL real quick. SVOL is not a closed-end fund. It's an ETF, but it's interesting to look at. I mean, it could be on the Divas, right? It has the chart pattern like the Diva down and to the right. Now, okay, the past year, that's actually a really good chart. I mean, it's gone from 18 and a half to 17 in the past year. Uh, okay, so yeah, so here's what this fund has. So they have, okay, they have bond futures. This is essentially a commodity fund now. I mean, but they have bond futures, and then they have some ETFs. They have some SPUC, which is Simplify, which is it's a ETF called that's supposed to give you the SPY plus upside convexity, is what they call it. So somehow it's like a SPY fund, but they also buy some out of the money calls or something. The idea is you should do well in a that you should do well in a that you should do even better than the SPY does in a bullish market. But I don't know if I'm all that sold on what they're doing. That I've compared it a couple of times to the SPY, and but let's just see here. SPUC. It's an interesting strategy. Let's compare it to the SPY. I mean, yeah, it does have some upside convexity. I guess I could see that. I mean, yeah, I mean, it's definitely. Now, here's the way money works, though. You got extra money on the way up because it has plus upside convexity. So they added some options to it somehow. But look at your downside. And why is that? Because they added some options to it. They added some extra longs. And so then when the market goes down, those longs, just those long options get destroyed, and the fund realizes a bigger loss than it otherwise would have. But yeah, SPUC would be good if you, or it might be something you consider if you thought a bull market was coming and you wanted to put on more risk. But yeah, but SFAL's an interesting fund. Back to the SFAL thing. SFAL's, you know, then they have some others. So they have the SPUC, which is a SPY plus upside. Then they have something called QIS. This is a hedge fund strategy. It's something I don't understand. Some multi-quant strategy that's I don't understand it, but it's real fancy looking. It's doing terrible, but lately. But anyway, then they have some. Other than that, these are pretty just basic stuff, just some bonds and some short-term stuff. Yeah, everyone and their grandma is launching auto callables. Brad is saying the problem with SFAL is the market had a great year and it should be much higher. Yeah. The other problem with it is no one really knows what it is. It used to be a very simple strategy. It used to be they sold VIX futures. And so if the SPY was up or even steady, this fund would do great because they're selling VIX futures is similar to selling S&P puts for whatever reason. So they do great. But then they went away from that and they went to like a multi-fund, fund-to-fund type deal. And yeah, I can't really get a handle on it anymore. It used to just be really simple to figure out. They used to have one short VIX futures. They were short one future in 1 month, and then they were long in another month. And they played the spread between them. And in the spread between them, that was the whole idea. It was kind of a complex strategy, but that's what they did. I don't even know they do that anymore. It looks like it's just a fund to funds with some bonds in it and stuff. So, but yeah, this one used to be a really good one back in the day because it paid like 20% and it was pretty good NAV and people used to love it. So yeah, I think people just don't know what to expect. So SFAL equals bonds, commodities, VIX, SPY, Qs, future. Yeah. But in the old days, all it was VIX futures. That's all they did. They sold VIX premium, and they did some type of VIX premium stretch strategy. But that's all they did, and they did a really good job. But yeah, they switched away from that. Okay, so Mark is saying XV and XXV are into barriers. It's the barriers and auto callables are the thing nowadays. So Marcus is talking about this fund, the Simplified Target 15% Distribution ETF. This is a what they call a barrier. a barrier fund, which means it has to drop more than 15% before it has real serious consequences. It's kind of like a buffer fund. But anyway, who cares what it does? Let's look at the results over the past year. The NAV's gone from 24 to 25, and it's paying about 10% yield. I mean, so heck yeah, so far. But there's lots of, then there's SBAR. This one, I think, just has a bigger barrier. Hang on. All right. Yeah, those are some good ones. All right. So, Brad, what are you saying here? Maybe SFAL needs some more yield max. Yeah, I think they need to go all in on Alti. That's what I think. All in on Alti, leveraged. You go all in on Alti with full leverage, and then go buy as many call options in Alti as they can. Right? That's the smart thing to do. Yeah, but to me, I think SFAL is having an identity crisis. But let's look here at something. Let me do it this way. Here's a better way to show this. We're going to look at SFAL versus Triple QI, and this is because it's a real old fund. This fund goes back to October of 2023. Both of them have been around that long, and but this was when SFAL used to be the real SFAL was back. So we're going to look at the real SFAL and we're going to see how it's doing against the new SFAL. So we're going to go 2023 to 2025. I mean, I'm trying to catch the old SFAL strategy. Okay, so the old SFAL strategy, and you could see it kept right up with the Triple QI, which is they sell premium on the NASDAQ. It's a bullish idea. I'll just put it in, but you could see it. Market goes up, it's going to go up too. That's the old SFAL. Let's look at the old SFAL against just the SPY, or maybe against SPY. SPY-I's been around that long. Let's look at the old SFAL against SPY-I. It's not going to beat SPY-I, but the old SFAL was legit. I mean, look, it was beating SPY-I for a little while, and it tailed off at towards 2025. That could have been around the time I don't know if they changed their strategy because they were doing bad, or they're doing bad because they changed their strategy, but something broke on this fund. This fund, SFAL, used to be a fine fund. I mean, SFAL was always one that, about up there. FEPI's a good fund too. Paid about 20%, same thing. FEPI and SFAL's good funds, good solid funds from back in the day. All right, guys, what else you guys want to talk about? I'm getting tired. Trying to think what's on the schedule for tomorrow. I have the top 20 show tomorrow, and that'll be good. I'll try to get up in the morning and shoot that. My top 20 show, I was griping about not getting many viewed, about my viewership's gone down. Part of the reason is because my effort's gone down too, but bringing the effort back up. But the top 20 show is one of my better shows every week. So I'm going to definitely put that out tomorrow. It should be out by noon. So I'm going to probably hit the hay and go do that. All right, guys. Marcus, what are you saying here? They're just trying to find ways to keep the NAV up. You don't think they care? Oh, we're talking SFAL. Yes. Yeah, possibly. So that brings a good question. We haven't thought about looking at that. Let's go look at how their NAV's been, or their AUM has been doing. So let's go to monthly, and then, or I guess this is just how far back it goes. Okay. So anyway, yeah, they came out, and like I said, fall of 2023, and that Triple QI came out in October of 2023. That's why I compared them. But this was the very start of when I got involved in this, and whenever the high yield craze started was late 2023. So, and you could see this thing just took off and blew up. And by, fall of 2024, this thing had 1.4 billion. Now, yeah, this was one of the most popular ones. It's like ULTY though. Its NAV has got cut in half. Everyone sold it. People bailed out. You know what my theory on that is, but what else happened right around this time is other funds came out that did the same thing and paid more, or maybe not exactly the same way, but there was better. I kind of think there's better choices, but yeah. So Marcus is just saying he thinks they aren't really worried about growth. They're just trying to make the growth of their AUM from the fund grow. They don't care about the total return. Maybe the fund manager just cares about this. So the fund manager is compensated off a percent of AUM. So say, when it's $1 billion under management, say the fund manager gets 100,000, it goes to his company or something. So then when it goes down to $500 million that year, that the company just makes 50,000 in fees, or they make half the fees. So they're definitely incentivized to keep the AUM up. However, if they can't intentionally make a fund that's going to perform bad, because the bad performance will also bring the AUM down. If the fund's assets stop growing, that's another problem. So, and then not to mention if the fund's assets stop growing, people will also sell the fund. So this one's just kind of having an identity crisis. I want to look at FEPI too. Now that I'm talking about FEPI, was a good steady one from back in the day, been around forever. Yeah, now FEPI been around since the same time, October of 2023, roughly the same time. And then FEPI grew from 5 million to $500 million by 2025. And FEPI kind of kept going. Hang on. All right. You were saying, I think you may be a new commenter. I like your good-looking dog right there. You're saying CEFs are a whole new world to me. So Skeptic BR and others in Discord have been very helpful. I just turn on the stream. We'll have to go back and rewatch. Yeah. Heck yeah. So if you guys like this type of content, every Saturday I'm going to do the top 20. We're going to look at the max factor, and we aren't going to just look at closed-end funds. We're just going to pull the best, whatever they are. There'll be some closed-end funds on the top 20 list tomorrow. I bet ASGI is pretty high on that list. And I bet there's a few other ones that slip into the top 20 tomorrow. But there's still there's lots of there's covered call funds that perform every bit as well as these do. So, they'll be on there too. But yeah, be looking for that tomorrow. Marcus is saying he thinks he figured out TrueShare's secret formula. They find a way to use fixed income in their fund strategies to offset other things. Well, yeah, probably so. That TrueShares is an interesting one. They have 1H. This is their latest one. We were talking about the other day. It just came out, right? It's been out like since the first of the year or something. Yeah, I was on the phone with somebody. I had a meeting on the phone with somebody, and he was just learning about this. We were talking about put spreads. I was teaching strategies, but he was asking me what a ladder is, because he keeps hearing a ladder. Everything's laddered this, laddered that. Anyway, so I explained to him what a ladder was. Well, this one is laddered. This has laddered put protection. And here it is right here. There it is. They just show it different. But anyway, guys, I'm tired. I'm going to get out of here. I appreciate you guys. Marcus likes, I remember I wasn't sharing the screen when I showed that. Whatever. I was just looking on my own. All right, I'm going to look at SFTY. Yeah, there's SFTI, the Horizon Managed Risk ETF. I'll get serious this week about adding some more closed-end funds in. That's not a closed-end fund. That's an ETF. Okay. Well, so safety, I haven't heard of this one yet. This sounds interesting. Let's see what these guys have. They have 7% Alphabet. They have some NVIDIA. Look at this. They own MAGs. That's cool. And then they have a little Microsoft, a little Apple, a little Broadcom. Berkshire, Walmart. Heck yeah, and I bet they have some type of ladder protection because the managed risk ETF. We'll just take a really quick look. Let's take a really quick look here. All right. It says they seek to capture the majority of a U.S. large cap equity market returns while mitigating downside risk through a risk assist strategy, whatever that means. So what they say is the risk assist strategy systematically adjusts the fund's exposure based on real-time volatility signals, reducing equity exposure during periods of elevated market volatility and re-engaging when conditions normalize. So this, yeah, what they do is they probably, when volatility's super high, they probably sell a lot. They probably overwrite the entire portfolio. Maybe when volatility goes down, they overwrite less of the portfolio. But that's usually how these types of strategies work. They have some type of formulaic system. So let's see how they've been doing. It's well, let's see here. Okay, safety. That's a good ticker symbol. Let's just run it against SVOL. Well. Let's see here. Oh, it's because I didn't go back. It's because I was too far back in the past. It's a new fund. Yeah, okay. So we can only go back 2/3 of a year, but I mean, it's beating SVOL. I mean, SVOL's not doing terrible, but safety's doing even better. All right, so let's see how much they're giving up versus the market. Not a whole lot. It doesn't look like they're giving up anything. On a total return basis, they sure aren't. It's right there. So this one probably needs a bigger pullback before we can really have a test of it. They rotate stocks and ETFs. Defensively rotates individually large cap exposures to hedge and/or take advantage of volatility. They'll even use ETFs like MAGs. All right, guys, I really am getting tired. Unless there's another last minute question, I'm gonna hit the hay. I'm gonna take a hot shower and go to bed. All right, guys. Well, I'll see you tomorrow. I'll see you. I'll try to have that new video up by like noon. All right. All right, guys. Well, thank you so much for being here. You guys have a wonderful evening, and I will talk to you guys soon.